So if we can agree, just for the sake of this discussion, just if you don't believe there's an algorithm, this for the purpose of me explaining something to you, just pretend for a moment that you do believe it is. Okay? And then at the end of the conversation, then you can move back to whatever you want to believe afterwards. But if there is an algorithm and it controls price and it only affords the market to go so high or so low for that given day, that means from the time it starts trading to the time it settles for that session, all of that price fluctuation, everybody in the retail perspective are going to see it as random price delivery. And there might be a pattern there that may justify them taking action on it. So they have a religious belief in some kind of pattern. For the sake of the pattern, they're going to buy or sell. And I'm trying to offer you a different perspective where you should be thinking, okay, what is the prevailing market sentiment right now about that given market? Is it likely to continue higher or lower for the next several days, up to the whole duration of the new week coming? Okay, because right now while we're talking, it is 40 minutes after 10 a.m. Eastern time. So we have several hours before we get to the new week opening at 6 o'clock Eastern time. So the markets are flat, they're not trading right now. And you should be thinking about what that monthly, that weekly chart is doing. Would seeing the price dropping lower to an old low or a gap of some sort, would it be beneficial for smart money if they were short? Would it be beneficial based on what that monthly and weekly chart shows right now? Would it be beneficial if the market was likely to go higher if smart money was long, to go to an old high or go to an inefficiency above where we settled at on Friday? That's your first question every single Saturday or Sunday, or if you do your analysis in the Friday evening or whatever. But before Sunday's opening, you need to do some reflecting on the monthly and the weekly chart, because it should give you a long-term, slow expectation where price is likely to go. And if it's not obvious, then drop down to the next lower time frame, which is going to be the daily. If you can't ascertain where the market's likely to draw to on the daily chart, then you absolutely have no business dropping down into the lower time frames, because you will be gambling. You will absolutely be gambling, because you won't know, trading on these smaller time frames, when that next trade you're taking is actually a higher time frame entry that's going to be the biggest displacement. And if you're trading without a stop loss, which I see a lot of that, just look at the screenshots everybody's tossing around between each other on Twitter, on Facebook, and on Instagram. They don't even put a stop loss on, even to save face, because they know if they put a stop loss on there, even though they don't have one while their trade is panning out in their demo account, they don't want to put that stop loss on, because everybody will know with a record that that's where their stop loss was. And when the market eventually goes down to that level, they would be technically stopped out, because they don't want to get stopped out. They want to hold on to something that if it keeps moving, they can come back and say, see how smart I was. So that's why when I look at people and they share charts and they say, I got the same trade as you, ICT. First question is I want to see the execution. I want to see the price, not the line, because the line could be 3 days ago, and it just so happens to look like it moved away from that price level. So I call my own students out with that bullshit. When I see people share a trade and they're a student of mine, and they show their entry, and they show they're getting ready to get their limit order tagged, but there's no stop loss, I'm not congratulating them on their good entry. I'm not congratulating them on the right draw and liquidity as an exit. I'm criticizing them by saying, where's your stop? Use a stop. That's mentoring. That's a mentor. That's someone who's trying to teach responsibility. I'm going to find your weakness because you're ignoring it, and you need to work there. And in the marketplace, it capitalizes on everyone's weakness. What are the two most critical ones? Greed and fear. All it has to do is operate on those two pretenses. It's going to either scare the shit out of you, or it's going to entice you that you're going to make a lot of money. Either one of them is going to cause action. It's going to cause a reaction, a response, a cause and effect. As a human being, you don't always know how you're going to react to something. And especially in trading, because most people don't do a lot of documentation stage of the development in the beginning. That means journaling, tape reading, identifying in laboratory experiments of watching price action, recording what your emotions are. Even though there's no money on the line, even though you haven't even pressed a demo entry, you are emotionally committed to the outcome of whatever opinion you form based on that chart at that time. Don't believe me? Think about this. You've opened up Eurodollar. You opened up Japanese yen. You looked at coffee futures if you're a commodity trader. You're looking at Bitcoin if you're a crypto crazy guy. And now for futures, you're watching NQ, Dow, NASDAQ. And you look at the chart right away, you're like, oh, I think it's going to go here. And it doesn't go. Oh, it doesn't matter because I wasn't in the trade. You quickly dismiss it. You quickly push it away like, oh, it doesn't matter. No one saw me say that. No one heard me think that. I didn't press a demo entry. I don't have to reset a demo account. I didn't take a loss in my funded account challenge. I didn't take a loss in my funded account. I didn't lose money in my real account. You're making excuses to push it aside. That's the worst thing you can do. You need to explore why you felt that impulse to think, oh, it's going to go up or it's going to go down to this. When you dismiss those instances where you have impulsively committed to some outcome and it doesn't work, the first thing you want to do is push it away like it didn't happen. Wrong. Because when you start trading with real money or in a manner where it's going to take from you money or prevent you from reaching your funded account, because you're paying for those accounts. And if you get wrapped up in this loop of ignoring your faults, you keep doing the same thing over and over again, failing and blowing the account and blowing the account and blowing the account and never fixing the underlying issue. And the only thing that increases in fervent pace is your pursuit to quickly reset the account or pay for a new challenge. And that just proves that you're out of control. You're not in control. You're emotionally stimulated beyond all comprehension. You're hopped up on goofballs. You don't even recognize the fact that you're doing everything wrong, because now you're now more passionate about doing it faster and quicker, and that way it'll cancel out that discomfort that you keep blowing the accounts.